Hello, everyone, and welcome to TradeFinder Live. It's great to be back with you all during this trading day and during trading hours. First and foremost, we do have to cover our disclosure disclaimer agreement. Main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. This is available on our website at all times, so please feel free to read it in detail at your leisure there, or take a screenshot of it now if you like. But that's the main point to take away. Again, yesterday, if you were in our members only group, you knew we were talking about the fear of recessions, and that seems to continue to concern the market. So, Rob, you out there? Let's get back into it.
I am, Zach. Happy Tuesday. We said yesterday we would have a better idea of what was going on today. Let me see. I'm not sure you can see my screen. So let me see if I...
Yeah, you just flipped your screen share over to Facecam. Or you flipped your Facecam to screen share.
So the audience just has me at the moment.
Right. That's all right. Nothing wrong with that.
We'll be back in just a second, y'all. Oh, nope. Yep. Maybe we're back.
We're back.
There he is.
Just figuring out technology.
Never works when we need it to.
Yep. Doesn't want to share my screen. There we go. All right. Nope. Still.
Yep. We're good.
We're good. All right. Yep. All right. So, take two. Yesterday, during our member session, we talked about the importance of whether or not there would be a follow-through day today. Since we broke that 570 level, if you watch the U.S. market update over the weekend, I talked about the significance of that 570 level acting as support, and that if we broke that level, there's a bit of a vacuum here from that move that occurred at the end of September up to 570. So that was pretty vertical, which means there's no resistance on the way down. So if we break that level, you know the rules. You look for a follow-through confirmation day. So today's close matters a lot. And at this point, if we were to close, that would count as follow-through, which means we're probably not done going down. We're probably going to find our way down to 540. Do we get a little bit of an oversold bounce first? We're getting a little bit away from the 10-day moving average, so possibly. But when we talk about the separation from the 10-day moving average and overbought, oversold conditions, you can stay oversold just a touch longer than overbought. So we did get a bounce into the close yesterday afternoon because we had gotten some pretty good separation there, but that doesn't guarantee that it's going to happen today. And maybe we bounce back up to 570 and work our way down to 540, or maybe we just make a quick straight shot down. We've been talking about the VIX a lot, and I think it warrants bringing it up now as well. We're starting to finally get a little bit of a spike. I've been commenting on how unusual this move was on the VIX. Not the fact that the VIX is moving up, but the fact that it was marching up like a stock would do in a trend. Normally you get these kind of moves, these big, huge spikes that you can see here, similar to what we may be trying to do today. You can see the high got near 30, and we'll see if that continues to the upside on that move. But it's just this march higher is a bit odd. And now even the VIX is a little bit away from the 10-day moving average. And just the question was, do we need one of these big spikes? Because normally when we get one of those, then we get a reversal and we start to come back down. Or is just the buildup enough of a increase in volatility? Normally you need like that washout. You need the big, huge spike in the VIX with a big down day. And maybe we end up there today. We're continuing to work our way lower in the market today. So maybe that gives it to us into the close, maybe not. We'll relook at it when we get to the end of the session. I'm going to go ahead and switch over here to the intraday chart and you can see basically just a big zigzag to the downside here on the intraday chart. And if I condense this, you can see that there is a 5-wave pattern. We're right in the middle of the tap box, almost the middle. We're in the top half of it, the middle of the top half, if you will. And with this nice 5-wave pattern to the downside, we'll see what happens if we start to get a bounce back to the upside. Perhaps we could bounce back up to 560 into the close if this 5-wave pattern is complete. So I thought I would go ahead and just draw this zigzag for you. And you can see this move here, and the 100% extension is actually just a little bit lower, but not too much lower than where we are right now. And that could yield us the potential bounce back up towards that wave 4. We'll see if some buying comes in. The last hour is when the professional traders come in. They did a little nibbling yesterday off the lows. Do they do the same thing today, or they just let the shorts have it and wait for even better prices to jump in? That's what I kind of surmise is likely going on, is the nibbling occurred on the low yesterday, moving to the upside, and then let's wait and see if that's enough to create a further bounce, or if we're going to get better pricing down below. And at least at this moment, that's certainly what seems to be occurring in the market. So we'll keep an eye on this throughout the trading session. At this point, we'll move on. The Dow's been holding up a little bit better, but you can see it did break that 420 level, closed right on it yesterday. It had been holding its support level, but it's given it up, having a pretty rough day on the Dow, and now relabeled into a wave 3 to the downside. So the fact that this is green means that that's still an active wave. When it's purple, and you can change the colors in the software, and if you haven't gone to hub.com and gotten a copy of the software, go get it. It's a great software. As you can see, you get not only live regular Elliott Wave, but you get live intraday Elliott Wave charts as well. So hubb.com. We had this expanding triangle. We broke to the downside. We're past where we would be on the breakout calculation. It's just a 10-point wedge here, so that would have brought us down to 420. We satisfied that yesterday, so breaking down a little further than you would expect out of this downward move. And when you look here, you can see that there's some separation now forming on the low and the 10-day moving average here on the DIA as well. Didn't really have that yesterday, but starting to build some today as the Dow is also trading on its low. We take a look at the Qs. This is an hour where things can get a little volatile. The 1 to 2 o'clock Eastern time hour, that's when all the professional traders go to lunch. And so the volume tends to dry up a little bit. So whatever move is going on can be exacerbated a little bit. And then at 2 o'clock, which will be right when we finish, they come back and perhaps if we stay down here on these lows, a little bit of nibbling occurs. We talked about the Qs over the weekend and yesterday on this wave 4 low. We moved a little bit lower today, so we're a little past the 61.8% fib level, but somewhere in that area. Certainly doesn't seem like this is going to set up for a wave 5. It feels like this pattern is going to relabel as well, just as we've had on the SPY. You can see that that's just left its Elliott Wave pattern altogether, which means we're in full-blown corrective mode here. So this is a big A wave impulse. How far that goes just remains to be seen. And when you have an A wave, you don't know which of the corrective patterns you're going to get. All of them have a B that retraces the opposite direction of the impulse A. So we get a B wave correction back up here. Is that going to be a flat? Is it going to turn sideways into a triangle, which I think could be kind of likely? Or the worst scenario would be, at least if you're bullish, would be a bounce up. We label a B somewhere in there. And then, of course, that sets us up for the C wave extension to the downside. And maybe that's what brings us to 540. So either of those three are possibilities because we're in the A wave, as I said, impulse, and we don't have a five-way pattern. So we just have to wait and see. They all start exactly the same way from the corrective side of things within Elliott Wave. Let's go ahead and move to the IWM, the one market that's been kind of on its own here, but maybe it's been the leader because it's had a zigzag pattern here in its wave 3. So a really nice, complex wave 3 to the downside. Love this pattern where you have a zigzag within a C wave. As you know, we did an IWM trade here on TradeFinder, and clearly we took that off too soon. Went a little further down than I thought it would, but we needed to see if we were going to break that 205 level, which is where we thought we were going, and we have. Now we're down here towards 200 is where we're trading right now. So maybe not quite as ugly on the IWM right now, but it started a bit uglier than the rest of the markets. Let's take a look at the bond market, because that's going to be really interesting to see what's going on there. I did a little bit of dissertation on this because when you look at it, you can say, okay, prices broke to the upside out of this consolidating triangle that we had, about where you would expect it to go, up there to 92.5. And now we're kind of figuring out what we're doing here. It looks like we're trying to create a bit of a triangle here. It looks like that's what's setting up on the TLT. And this is the 20-year and pricing. Remember, prices and yields move inversely. So as prices go up, yields and rates go down. And there was some chatter on the financial networks earlier that you would have thought with the fact that rates are going down, it would be good for equities, especially the Qs and the IWM. Hasn't played out that way. And my commentary is because it matters why there is a bid in the bond market. If the prices move up and yields and rates move down, and you've got kind of just a normal setup in the economy and in the markets, then of course that's very supportive of small caps and tech stocks. But when buying is coming in because money is leaving the equities market to go hide in the bond market, which is something that happens commonly, and that pushes prices and yields, prices up and yields down, that's not conducive to, obviously, a move higher in the equities markets. But it will get to a point where when all the weak hands leave the equities market and run and hide, that's about when things turn. So right now, a little bit of a bid there. I know you guys like the TNX. We'll look at that. That's the 10-year, so a little shorter on the yield curve. And this is yields and rates. So TLT's prices on the 20-year, TNX's yields and rates on the 10-year. So they're going to be opposite. And this shows you the drop in yields and rates that's occurred in the 10-year. Same, almost identical chart to what's going on with TLT, just inverse because one's showing price, one's showing yields. And it looks like we're building a little consolidation here in the 10-year. So perhaps if the bond market calms down a little bit, that could add a little bit of a bid into the market. But now, as Zach mentioned in the beginning, we have recessionary fears that are coming in. All of a sudden, we're worried about a recession when we had an inverted yield curve for a year, and we hadn't had a recession yet. Every single recession has been preceded by an inverted yield curve, but not every inverted yield curve yields a recession. So it's an important distinction there. Just because you have an inverted yield curve doesn't necessarily mean you're going to have a recession. Most of the time it does, but not all the time. But it sets the stage for one because we've had that one thing that has preceded every single recession that we've ever had. One of the few things that's 100% in the world of trading. Most things aren't, as you know. So we'll see if we get a little calming here. But if we're consolidating into another triangle, that means we're going to get another break. So which way are we going to break? The concern here is the fact that we do have a wave 4 right there around 61.8. It's a logical place for yields to bounce, and they have. And that's because of the 61.8% fib level being such a strong fib level. Is this going to be a wave 5 to the upside? We would not want to see that. Hopefully this chart relabels. And for those of you that comment on the U.S. market update, these aren't my labels. I don't put these on here. Oftentimes people say, I disagree with how you label your charts, etc. Just as a reminder, the algorithm within the software does this. I don't do it. I just try to read and analyze what's being shown on the chart and give you the best commentary that I can on what I see and what I feel is being told by the technicals that are shown through Elliott Wave and the other indicators that we look at. But it's the algorithm that's programmed as Ralph Nelson Elliott wrote it that does all this labeling. And the relabeling is part of Elliott Wave. I hear people say negative things about the charts relabel. There's actually a couple joking comments about that on the U.S. market update. And I just feel like people look at that the wrong way. Nobody knows for sure where the market's going to go. Elliott Wave is a great indicator. It's not 100%. Nobody knows with certainty where the markets are going to go. So what you do is you analyze things the best you can with the data that you have on hand at that time. And that's the best we can hope for. But the markets are ever changing. They're dynamic. They're not static. And if you don't have an indicator that's quick to change with the market, you can stay in the wrong direction for too long before whatever indicator you're using turns around and moves the other way. Elliott Wave is very fast to relabel when things change. And I think that's a positive. So I wish people would view it that way and have a different outlook on the relabeling aspect of Elliott Wave. It's what you want. If things change, then you want to be able to change and move with it and move with it as quickly as possible. So pretty good stuff there. And now the dollar is kind of hinting towards this recession stuff because of that big move to the downside. It's stabilizing a little bit, but again, we got a little far from the 10-day moving average. Doesn't matter what security you're looking at. All the rules are the same. In this, the dollar has just been acting weird ever since last fall, early winter, with this big move to the upside. The dollar doesn't usually move directionally like that, not that far in a directional standpoint. Normally, the dollar is bouncing around. It consolidates, makes moves, possibly more of a stair-step type move when it's moving directionally. So that was unusual. And then this big drop that we've had over the past week is unusual as well. Normally, I don't get quite that vertical of a move out of the dollar. So the fact that the dollar is dropping when we've had yields for a long time that have been higher, just a little bit of a drop in yields, was that enough to bring this down? Were people really just in the dollar because our rates were a little bit higher and that was supporting it? It seems like now there's concerns about a recession and the amount of debt that we have, and that word being thrown around. You've heard me mention it once or twice, but stagflation is starting to show up on people's lips here and there. As far as you having a situation where inflation remains higher. Chairman Powell did a speech on Friday, and he was almost kind of giddy in his speech and talking about how they were pretty comfortable. Inflation was moving in the right direction. They don't seem that concerned about it, even though it's not back down to their 2% level yet. They seem content with the direction that we're moving with inflation. And then rates have been, kind of cooperating a bit. But if we start to get, at least on the longer end, even though they're starting to tick up and it's affecting the housing market, as we've commented a week or so ago, housing market's a mess right now. But you just wonder if the Fed is content to sit on their hands. As they say, they seem to be very happy just watching and waiting, see how things play out. The one concern they seem to have is the labor market, not the economy. But they said if the labor market began to weaken, they would consider stepping in and cutting rates. Now the Fed Fund Futures is starting to price in a rate cut in May. They're now, some people are on the financial networks this morning, which before we were pricing in 3. I thought that might be a little bit aggressive. Now they're saying maybe 5 throughout the rest of this year. So some people are expecting cuts to start May or June and then have several more into the end of the year. It wasn't that long ago that we were barely pricing 1 in for December. I just don't think the Fed is going to jump and come to the rescue of the equities market. I think the only thing, at least if you believe what they say, that they're worried about is the labor market. So as long as the labor market stays okay, they're not that concerned about the economy. If it weakens a bit, so be it. Eventually it was going to, once the rate hikes that they did in the past work their way through, and they just don't seem to be concerned about any sort of a significant recession. And by the way, if you're not familiar, the definition of a recession is 2 consecutive negative quarters of GDP. Tomorrow, we get the CPI report. That's going to be a market mover, quite likely, with this volatility that we have now. Probably going to get a big move in the markets, at least short term. You've seen the deal when the Fed comes out and makes their moves. You get the big spikes, and then it usually retraces. We might have something similar tomorrow when the CPI report comes out, and then we have PPI, which is the wholesale level producer price index on Thursday. So a couple big numbers to keep an eye on. Most people don't pay too much attention to the PPI. Everything's focused on the CPI. But the one thing that I look at is, are we getting a tick up on the PPI, but not on the CPI? And then that means that on the wholesale level, producers are having to pay more, but they're not able to pass on those excess costs to the consumer, and that can compress margins. So most of the time they're fairly in line, but that is the one thing that I pay attention to is the spread between the PPI and the CPI. So just a little bit of a note there, but yeah, we will be taking a close look at what happens with that CPI tomorrow. So that's where we are with the dollar. Let's go ahead and take a look at the metals real quick. Gold's getting another little bid today. Nothing too significant. You can see a pretty nice consolidation pattern being formed here on GLD, which makes sense. Had a big run up, and if you're bullish on gold, you would be happy with this kind of a consolidation. The fact that we didn't give more back, we had a little bit of a tick down, but nothing significant. So a nice consolidating triangle following this big move is warranted. And then you can see that we are creating this complex wave 4 here with this triangle, and we'll see which way we break. Perhaps it stays a wave 3. If we break to the upside and take out this 3, maybe the 3 moves over. If we break to the downside, then I think we would likely label a 4 through that, or the software would. But just speculation there. But the metals are performing very well. That's where you want to be hiding right now, it seems. SLV, we had the triangle as well. We've been talking about how the SLV needs to play catch up. Well, it has got its triangle of its own here, but it's trying to break out today of its triangle here. So we'll see if that continues. We need the same rules that we talked about as far as breaking support. We need a follow through or confirmation day on SLV. But if we get that, then that would likely tilt your hand towards thinking the GLD would break out to the upside as well. So too nice. It's nice to see, even though they're different patterns, this 5-wave pattern to the downside here that's still technically, but just barely qualified. We're just right under that fib level. So ever so close to being disqualified. And if we do get the upside breakout confirmation here and the metals continue higher, this pattern will relabel and probably join GLD in a wave 3 to the upside type of a setup. So good to see the metals, even though the pattern's slightly different from an Elliott Wave labeling, but both in consolidation phases and look to be breaking out here in the not too distant future. Natural gas, which had a bid yesterday, but given some of that back today, filling this gap as we've talked about, and notice that wave 5 on UNG relabeled to a 3 as well. So the algorithm is not sure that movement to the upside is complete. Remember, the wave 5 went right into the middle of the tap box and went exactly where it was supposed to go. And then you wait and see the bid that finally lasted here within natural gas was the fact that all these new data centers that are being built are going to be using natural gas. But it takes a while to build those. Not all those factories are going to get built as fast as Elon built his. It takes time. And then it's just speculation. How much natural gas are they going to use? How many data centers are they going to be? And what time frame will they be built? So there's a lot of questions. So this is in anticipation of that. So it will likely be a buy the rumor, sell the news type thing on UNG. But we'll have to wait and see if that wave 3 high can be taken out. If it is, then perhaps we continue just a little higher. This nice zigzag pattern here is giving you about a 61.8% extension possibility here. We got very close on the high yesterday, so maybe a little bit more of a tick up in natural gas, and then perhaps it bumps its head. We have basically a 38.2% B wave correction. You know, that normally yields to a 61.8% extension. And then we look to see if we get the further C wave extension, which happens a fair amount of the time, where it moves to the next fib level. But what's supposed to happen on a 38.2% corrective move is a move to 61.8. So that's what's supposed to happen. And then we'll see what actually does happen, because if the move is strong enough, oftentimes it will move and give you that extended C wave to the next fib level. Looking at oil, a little bit of a bid today from yesterday, but we closed lower yesterday. We're kind of right in the middle of this range. We retraced back to the point of the triangle, so following all the rules there, that's what's supposed to happen. You break out of the triangle, you come back and test the point of the breakout. We've done that. Right at 72.5 was where the breakout point of the triangle was. So we're consolidating right there, and also right in the middle of this big range that I've been talking about is likely where we are going to be on USO. Pretty enticing to actually take a look at a potential calendar spread. Be an awfully wide butterfly, be too expensive, but calendar spread around 72.5 maybe, but how long can we expect it to stay here? Usually kind of difficult to do calendar spreads on USO because it just moves too much. It doesn't stay in a point long enough. And the fact that we've consolidated here this long means that we're probably going to move away from that level. Don't know which way it's going to be, but I do think it'll stay between that 65 and 80 area. A crude, not real well formed, but crude small triangle right there, right at the 72.5 as we're consolidating that previous breakout move. So let's say 3-point, 4-point move or so at a USO is probably coming. But again, we don't know whether it'll be to the upside or the downside. Just have to wait and see on that. Going to cryptos, which have not been performing too well after the announcement of the strategic reserve for cryptos. The administration came out and talked about what cryptos were going to be in the basket, and that gave them a quick bounce, but then we've retraced it immediately. So we had a big move up, and then everything's come right back down. We talked about this a few times, that if this level right here around 87.5 didn't hold on, Bitcoin probably coming down to this support level near 70,000. We're getting awfully close to that now. So maybe a little more to the downside to go on Bitcoin, and then we'll see if this level can hold. It's not the greatest level of support right where that support line is. We might even have to drop that down through this bit of congestion through here that occurred in the fall and early winter last year. But perhaps this little bit of support can be enough. We'll wait and see. But if not, then we're probably coming down to that next level and there, and maybe all the way down to 70,000. So there is a little bit of support in this area. It's just not fantastic. Ethereum performing a little bit better today, but ugly day yesterday. Ethereum just seems to be whittling away. Doesn't want to play the game as far as the move to the upside that some of the other cryptos have enjoyed. It had a little bit of a bounce post-election here, and then it's worked its way back down, had less of a bounce last Sunday when the strategic reserve was announced. Also came right back down. And we talked about how this level right here at 22.5 needed to hold. And if it didn't, that we were probably going lower. And you can see it didn't hold. It tried, stayed there for about 2 weeks, almost 2 weeks, but didn't hold. And so we've broken down, which you would expect. Where's the next level? This is where it gets a little bit dicey with Ethereum, because you can see how strong that level of support at 22.5 was. That's why it was so important for it to hold that. You come way back, all the way back into the beginning of 2024 before you saw it at that 22.5 level again. And the concern is this move here was a bit vertical coming from the fall of 2023 as we ran up to that 22.5. That's down around 1,500, which is where Ethereum is probably headed, and it's not that far away from it already. So the next little area of support would be right down here around 1,500 on Ethereum. A little bit oversold from its 10-day moving average, but not real significant. And we'll see if that's enough to keep it there or not. And then we move into the one that has held up better than even Bitcoin is XRP, the talk of the town, the meme crowd. Everybody's loving this. The problem is we were trying to build a little area of higher lows, which could have forecasted this potential march higher in a wave 5 up to $4. A pretty good wave 4, although I hate it when the wave 4 is labeled with just one individual bar. Usually like a little more consolidation there. Maybe that's what's going on now, is we're going to come down and test that level a few times. And if it holds, then maybe it gets enough of a bid to head back to that wave 5. But if it breaks this level, then we have to start looking at some significant downward potential in XRP. There's some support right here at $1.50, and that needs to hold. Otherwise, we're in danger of giving away all of the post-election bump that occurred here, where we went from 50 cents up to $1.50 really quickly following the election. So if $1.50 doesn't hold, it's almost a Katie bar the door, Zach. It's a pretty good move, a full dollar move down in XRP. So breaking this trend line is not good, and maybe you can try and hold here, but there is a potential for seeing at least a test of this wave 4 or potential move all the way down to $1.50 there on XRP. Solana, all these were doing better this morning, and they've given back some of their earlier gains as the market has continued to weaken throughout the day. This potential continued move down here, but we're in an area that needs to try to hold. You can see it's trying to hold in this area because we have the same scenario here as we do with Ethereum. If we can't hold here, then as I condense the chart, once again, you can see how important this level of support was. It looks very similar to the chart of Ethereum with all of these tests of this area right here. And if it doesn't hold there, one thing that is different is there's a bit more support here, not too far below. So there's a bit of a corridor of support right through here, and we're kind of in the middle of that right now. So anywhere in this range, you could even bring it down to here, if you want to be a little more conservative. Somewhere in this area would need to hold on Solana, or you start looking at giving a whole lot of that back as well. And then the one that kind of surprised everybody that was included in the strategic reserve was Cardano. Some people had kind of forgotten about it, even though it had a big run post-election as well. And then you can see the size of the bounce that it got. You could argue more percentage movement out of Cardano than any of the other cryptos, and it was a 60% move. And again, that was because that one kind of caught some people by surprise that it was going to be included in there. But right back down, just like everything else, also in an area that needs to hold right in this area here, around 70 cents, somewhere in that area. It trades through it, so you could pick your favorite spot there. You could move that trend line up or down. I draw it through the middle when a security trades through a price. I call that congestion because it doesn't really act as support or resistance. It's just it trades there a lot. It's even touched it on the high today, as you can see. But if Cardano can't hold in here, then yeah, that's looking at giving all of the post-election bump back as well. And that's a heck of a move. That one really moved post-election from roughly 25 cents up to $1.25. Heck of a move that occurred there. And it would be in danger of giving all that back. I don't know that anybody knows exactly when the purchases are going to occur for the strategic reserve. Perhaps it's out there. I haven't seen it anywhere. Zach, I don't know if you've heard of anything about a planned time frame, but the one thing that I have heard, and this is the naysayers on Bitcoin, are saying there really isn't going to be the purchases that people think. They're going to move the Bitcoin the government already has that's been seized from illegal activity into the strategic reserve. So there won't be actually nearly as much purchased as some people may think. That's just somebody's opinion. I don't know how widespread that viewpoint is, but thought I'd pass it on because I read that. So yeah, some odd things going on in cryptos and some major areas of support that need to hold. We've been starting to break down in the equities market from those support levels. Can we hold here on the cryptos, with Ethereum seeming to already have broken below its level? All right, let's take a look at a couple international markets real quick, and we'll see what's going on around the world with all of this. Chaos is the word everybody is using here in the U.S. And I don't think it's really chaos. It's just uncertainty. And, the Treasury Secretary came out and said there's going to be a detox period. That's what he called it. And if you just use a little bit of common sense, President Trump wants to bring manufacturing back to the U.S. and he wants fair trade. So the tariffs, we've been paying tariffs for a long time. And so he's trying to level the playing field, and they don't like it. But it does seem to be the fair thing. Why should we have to pay tariffs on our goods overseas and not for their goods coming here? It doesn't make any sense. So he's trying to level the playing field. And he also wants to encourage manufacturing to come back to the U.S. by not allowing it to find cheaper manufacturing elsewhere, bring it back here. Well, you can't build a manufacturing facility overnight either. That takes time. And this is going to be a long-term process. So he's looking towards the future. I don't think he expected this to all get fixed overnight. So if you just think about it from a logical standpoint, there's going to be some hits to earnings, et cetera. And some companies are saying they're going to invest in factories here. Do they follow through? Do they actually start building them? How long does it take to build them? Kind of all the same questions I was asking about natural gas. All that stuff plays out. So all this stuff that's going on is really not that surprising. The uncertainty part comes in when, tariffs are on, they're off. We're pausing. We're going to put more tariffs on. We're only going to put tariffs on certain things. We're going to exclude some things. Maybe the tariffs won't be as high. It's the back and forth is what the market doesn't like. The market can deal with anything. The market will price in anything that's going on. It can handle it. Money will rotate and move around. All those things, not a big deal for the market if it feels that it has a pretty good idea of what's going to happen. When it's not sure, that's what rattles markets. The uncertainty part is what creates the excess volatility in the markets and causes these problems. So we'll see how it all plays out. But it's going to be a long-term thing. So we might actually have a down market for a while, which I think would be exciting. It would be fun to put a bunch of downside trades on for a change. It's been a while since we've been able to do that, going all the way back to COVID before we had an extended enough downward move to where you could actually start putting on some put positions. It takes time for downside patterns to set up. You get the big flush out moves, and then you get backing and filling, and then you get an idea of what the pattern looks like, and then you can start putting on some downside trades, and that'll be exciting from a trading standpoint. As they were talking about on the financial networks this morning, not so exciting if you have an IRA or a 401k. Doesn't feel too good then, but like us, if you trade options, it's a good thing to have that scenario set up. So, all right, that gives you a rundown of my commentary here. Got on a soapbox there. Australia, right down here at the wave 5 area, right around 23. We're in the tap box. Perhaps we extend 100%, but we can stop anywhere in here. And I was asked to explain this in the U.S. market update, so I thought this will be a good venue to do it. One of the comments, and again, I read all the comments that you all write. I respond to as many as I can get to, time and travel permitted, but I do read them all. And there was questions about, what does this tap box mean? And it stands for time and price projection, so TAPP. And you can set it the way the software allows you based on Fibonacci levels, which is what I use, or statistical probability. Some people prefer statistical probability. I'm a big believer in Fibonacci ratios. I've found them to be amazing points of support and resistance, price targets, etc. Elliott really likes Fibonacci levels, but if you're not as a big believer in Fibonacci levels and you just want pure statistical probability based on what's happened, you can set the tap box for that as well and change it. And I'll show that to you real quick here, because imagine a lot of you actually have this software. So if we just go here to the little gear in Elliott Wave, there's the tap box. And you can see right here, time and price. There they are. There's the time. There's the price. See, mine are set on Fibonacci. And you can change it to statistical if you want. You can make it statistical probability and change that tap box. So up to you, whatever your preferences are. So again, many cool features of this software that you can play around with and set your charts up the way you like them, etc. Really amazing piece of software. So back to Australia, we'll see if we hold somewhere in here. If we get another break out of gold and silver, Australia tends to move a little bit with the resource market. We'll see that plays in. Tariffs on copper, is that going to affect it? Some people are saying maybe, and that could be a little bit problematic for the folks down under. And then we go to EWC, take a look at Canada. Canada seems to be in the news every single day. And it was holding up pretty well, and it's finally started to move to the downside as well with all this stuff going on. I would have thought with all the rhetoric that's been going on, there would have been more volatility in the EWC before this. But with this corrective move that we're having in the U.S., we're going through correction as well here in Canada. You can see we're right at the B wave corrective level that held back in September of last year. Will that hold here? We'll have to wait and see if that's an area. If not, then we're going to retrace, which could very well happen. That entire zigzag, once any sort of an Elliott Wave pattern completes an impulse pattern, and people get caught up in, why do you keep talking about zigzags in the wave 3 as a directional pattern? Zigzags are corrective patterns. It's only corrective by name. A zigzag is a 3-wave directional pattern. You have an impulse move, a B wave correction, and a C wave impulse. It's a directional pattern. It's one of the 3 patterns that follows after wave 5 completes. So you have the 5 waves, and then you're going to go through a corrective phase, which will be a flat, a zigzag, or a triangle. Triangle is sideways consolidation with a potential breakout. A flat is a sideways consolidation. Don't necessarily have to break out of that. You can just kind of slowly move out of it. So those are both sideways consolidation patterns, but a zigzag is a directional corrective pattern. And again, it's only corrective by name because it's one of the 3 patterns that occurs after a wave 5, but it's a directional pattern. So if you find it within an impulse wave, it works to give you a potential target on the C wave. And just like a 5-wave pattern, if it goes less than 100% on the wave 5, it goes back to the previous 4. When zigzags complete, it oftentimes retraces the entire zigzag. So if we don't hold right here on the EWC, we're probably coming down to the 0 point, the start of that zigzag. And then Germany, the ECB has been very aggressive in cutting rates. We're getting a little bit of a correction here due to the fact that the U.S. is, but we also got a little bit overbought here. But markets like cutting rates. And at some point, if we start to price in that may cut more, that could kind of give a little bit of a bid back to the U.S. market. But the ECB has been cutting rates for a while. They've been more aggressive than the Fed has, and that's yielded these moves to the upside. So a little bit of give back here. Is it because of what's going on here, or is it just it needed to consolidate an overbought condition? You can make an argument either way, but it is holding right at the 10-day moving average, which is pretty darn impressive. And then the INDA, and that's India. We talked about this little bounce that we got on this wave 3. Are we going to get this last fib extension here? Since we had basically a 50% B wave, you go to 100%, it broke below that. So that brings in the possibility of 161.8% extension. We came down, had a doji, a little bit of a bounce, and we're kind of consolidating here. Just want to reiterate, does not have to go down to the 161.8% level. It's already done what it was supposed to do. It was supposed to go to 100%. It did. It's just, this is one of those things that I was talking about earlier that you keep an eye on. Will it move to the next fib level? So we watch that to see. And that wraps up all the market stuff. Zach, I'll go ahead and take a few questions now. And then as we did last week, which I kind of like that format, we'll come back at the end and give out our case study to see what we can do in March with perfect record in February. So we'll give out a case study consideration for today and take a few questions at this point.
Sounds great, Rob. And just to go back to your question on crypto, upon the Senate bill being introduced, it would be a 5-year period that the buyback would have to occur in, but it's still uncertain when the actual big purchase date will take place. So as you speculated, might not be announced until it's happening. Anywho, let's get into some questions. I'm going to start out with one that's becoming a norm that was a norm of the past and kind of went away and is resurfaced. So, as you might allude to, that's AMD.
Yeah, I was already typing it in before you said it. I knew where you were going. Thanks for the information on the cryptos. That certainly makes sense on why that big initial bounce was immediately retraced, because you're talking about a 5-year period over time. So it's not going to be, doesn't sound like it's going to be anything too major and anytime too soon. So that makes a lot of sense. So AMD, trucking on down. We've talked about this needing to hold this 100 level. We said if it broke 110, it was probably coming down to 100. It did. It's been trying to hold there. Big round number. The wave 5 is lower. And in today's move is trying to break below it. It closed below that 100 level yesterday. But as far as this moment right now, it's not a follow through day because it's right at that level. It needs to close lower to be a follow through day. And if we do get a follow through day, then I think you could say we're going to be in this tap box somewhere. So I would say 90 would be likely on AMD if we close lower today. If we don't, it doesn't count as follow through. And you wonder, well, what does that mean? It just opens the door for a potential bounce. If you don't get a follow through on a break of support, then potentially it could bounce back up. But at this point, the bounce would be back to 100. It needs to get above 100. So if you're looking to go bullish, you got to get back above 100 and back above the 10-day moving average. And then perhaps you get to move up to 110. That's what we've been talking about. If we get follow through today, so if it closes lower today, then I think you're going to see 90. So there's about a 7-point potential downward move, a little bit more than that to the upside if we can get back above 100 and recover the 10-day moving average.
Let's head over to Meta for ERV85.
All right. Meta, lots of chat about Meta on the financial networks this morning. Opened nicely and see where it is now. Still a little bit higher, but given some of that initial bounce back, the problem here is it's a little oversold. So even the bounce today really doesn't mean anything. There's some congestion right here. I guess I shouldn't say that because since we closed below that level of congestion yesterday, you'd be looking for a follow-through day today, just like we were talking about with AMD. And if it doesn't, then you're coming down here to this next level. I can switch over to the crosshairs and tell you about where that is. So that would be 575 or so, and we got in that neighborhood yesterday, so it wouldn't be too much lower than here. And if that doesn't hold, then you're down here at 550. But there's a pretty good corridor of support here between 550 and 600. So the wave 4 is right at 50%. Maybe that's enough to give it a bounce, and we turn back to the upside. Maybe Meta can lead us out of this mess at some point. The tech stocks are going to be really interesting. They got way overvalued. You know the story, Mag 7, the big run, all that stuff that was going on. They got overvalued. They're correcting hard. And at some point, they're going to be attractive to investment managers again, and they'll get a renewed bid. Maybe Meta's the one that leads us out of that because not only are we at 50%, but as I said, there's a pretty solid corridor here between 550 and 600. So your risk is down to 550. And if we can get back above 600, then we have to contend with this next level of resistance. So it's got a little bit of a, just like it's got a corridor of support, it also has a corridor of resistance between 600 and 635 there. So kind of a bit of a between a rock and a hard place here on Meta for now. So I think it's kind of a wait and see which way it goes on this point on Meta.
Good old Palantir, PLTR.
We're getting some of the standard names coming back. I guess people are wondering, is it time to step in on some of these? It was talked about a lot this morning on whether or not it was an opportunity to step in. And as you can see here, the wave 4 is trying to hold in this 50% area. It would have been nicer if we held that area, which is around 85. It tried a little bit for a few days, couldn't hold it. But, you know, when you get a sell-off like we had yesterday and are having today, then it brings most stocks with it. But these are pretty big corrective moves that have occurred in these stocks. Thought maybe you could look for taking a flyer here back when it was sitting here at 85, but commented that if it broke that, you get out. That was your support. So you had low potential risk and a potential bounce. But if it broke below that, then forget it. And more conservative is getting back above the 10 and 50-day moving averages. So Palantir has some work. It's got to get back above what is now going to be resistance at 85. And then right above 85, it has the 10 and the 50-day moving averages. So it almost needs to get back to 90 before you'd feel a little more comfortable stepping in. This corridor here that I've drawn with these lines could anywhere in there could act as support. It might have to come all the way down here towards 63 or so, but it could find footing anywhere in here. So it's definitely starting to get interesting on Palantir. If you have a iron stomach and would be willing to put up with some potential move lower, if you're looking for something for the long term, then maybe you nibble on this a little bit. But if you're looking for a trade, I think you got to wait. You got to let it get back above resistance and the 50-day moving average.
Staying with the theme, NVIDIA.
Yeah, it's almost. You guys oftentimes come up with some really unusual symbols, and ones that we haven't talked about in a while, etc., and makes it fun. But it's kind of fun to take a look at some of these tech stocks that have been beaten up. And what can you say about NVIDIA? Most people are saying they're going to kind of nibble if it sees 100 again, and we're not that far away. So at this moment, we're at 108. You can see a little separation from the 10-day moving average. It's been just a steady march down. It never really got that oversold, never got too far away from its 10-day moving average enough to give it a bounce back up towards it. It's just been kind of moving down here in a slow, steady move from the breakout of that symmetrical triangle. So nice breakout from the triangle. We actually looked at doing a strangle here, but just too much premium in the NVIDIA options still built in from the past with this stock. And you can see in this area is the boundary range. It's one of our AI searches. This is the likelihood of a stock staying in a trading range after it drops. So you can see that we got a little bit above the upper boundary. Now we're testing the lower boundary. So that's kind of in this area. And then we have that big round number of 100 here. So, maybe NVIDIA's earnings are good enough to set a renewed bid, and it comes back to life here. It's going to get to the point, as I was talking about earlier, NVIDIA is one on a lot of people's shopping lists. Like if I can get it at 100, I would be really happy. Maybe it gives us 100. Maybe it turns around just before that. You can see how that acted as support back in August and September of last year as well. But it's getting pretty interesting.
Got time for a couple more before the case study consideration?
Yep. Let's do two more.
All right. Let's go over to NEO for Lisa.
Back over to China. See what that looks like. Getting a nice little bounce here off this long consolidation, months and months and months, just trading here at $5. So it's trying to break out. It tried it once before in February and got turned back. So can it do it this time? Will be interesting to see. It got in the neighborhood of its previous wave 4. Maybe it needs to go all the way back there. The wave 5 didn't quite make it down to the tap box, but it went through a really nice sideways consolidation here following the wave 5. Again, one of the three things that's going to happen when you have a wave 5 end, trading near the high of the day. So having a very good day. And if it gets back to the previous 4, then we'll have to look at it again. If it can break that, then we might have something going. But this is definitely a follow-through day to the upside here. But we tried it last month and got turned back. Can it hold it this time? If so, then you could see a pretty good bid come back into NEO, especially with all this stuff going on between the U.S. and China, and China really focusing on their own EV market, et cetera. Can certainly see a bid come in there.
Alrighty, and I know you covered the metals. This one specifically is the miners for Maria, GDX, 2 qualified zigzags, but bumping against resistance. I'm long the stock.
I think it's a good place to be. And we're going through a bit of consolidation here, but unlike, as you saw, pretty much everything we looked at, except for maybe NEO, it's holding above its 10-day moving average. And with gold catching a bid, silver getting a bid, again, the miners are their own deal. They don't necessarily follow exactly with the metal, but it does give a base case of what should happen. You get an expectation of where it's going to move based on what the metal's doing. So with metal moving to the upside, I think GDX is a pretty good place to be. And I still think that the likelihood is that we're going to come test this high from October up here at that 161.8% extension from the zigzag way back here, going back into last summer. So that's where that line came from. So I don't have it drawn there as far as expecting it to go there. It's already done that. That's a past zigzag. I'm looking for it to test that previous high. In fact, I should probably just take that off and then just draw a support line there, which is a bit more appropriate because it's not a Fibonacci pattern that's being traded at the moment. So we'll just draw this trend line here for when we look at it again. That's the expected target. I think it goes and tests that level. So yeah, I think owning the stock's a good idea, Maria. Don't worry about time decay and all the volatility in the option world right now. But think about it. If it gets up here, then let's really take a look at what's going on with gold and see if it warrants any further movement to the upside. But I do feel like it likely sees that level. All right. So we didn't look at Apple. We left one out. Pretty interesting. There's Zach. So out of the group, you can see what's going on here, and the whole Siri news and everything is what sent the stock down yesterday. Almost kind of had a lot to do with the start of the big move lower. Most people said it was Delta's comments that they're not seeing the domestic travel that they once were. It slowed up a bit. We know the economy is slowing. There's a difference between a slowing economy and a recession. There's no question that the economy is slowing. Does it slow enough to put us into an official recession? And as a consumer, as an average consumer, I'm going to get on a soapbox again here. When the economy slows, it feels like a recession to us. It's just the official definition of a recession is those 2 quarters in a row of negative GDP. But who cares whether it's official or not? We feel it as consumers when the economy is slowing. So just thought I would throw that out there. But we've got Apple sitting here on a very precarious level right here at 220. This is where it bounced last time. When it came down here, it bounced off 220 and moved back up to the formation of this triangle. So that was in January. You can see where it was here, and it bounced back up. We are looking like we're getting confirmation on a downside breakout here, unless there's some sort of a major rally here. So let's take a look at the width of this triangle. So 220 up to, call it 250. So it's a 30-point mouth of the triangle. The point is at 240. So you subtract 30 points and you look for a move to that level, which would give us 210 on Apple. So I'm going to step out of my comfort zone here. It's a stock that I always say is the worst one to short, is Apple. But I think that there's a possibility that it moves to 210. Looks like that makes a lot of sense. But the problem with Apple, as I've mentioned, the reason I don't like to short it is their board has so much cash. they can step in and initiate very large stock buybacks at any point in time. I suspect that's what went on here from the last move off of 220. Would they do it again? They might. So you have to keep that in mind. But it does feel like it wants to try to reach 210, but don't feel confident enough to make that our case study consideration. What we are going to do is we are going to look at SLV and use this. This is just going to be a post, Zach, because there's no follow-through day yet on SLV, but it does feel with the movements today in gold and silver that they're going to continue. So we're just going to do a post SLV to move higher up to 31.
Very well. Thanks, Rob. I'll go ahead and make sure that that is posted. Since we are just doing a post, might just go ahead and get that up there for everyone. And since we're about 5 minutes over time, I'll pass back over to you. Back over to you to provide final thoughts. And thank everyone out there for taking time out of their day to join us.
Yeah, especially on a day like today where who knows where we finish. But today's close is important, as you saw from the charts that we were looking at. Going back real quickly to the SPY, we've had a little bit of a bounce here in the last 30 minutes or so. So I'll give you one quick intraday look here. There's that bounce that started about 130 and still, I thought so. It did actually label that as a wave 5. We came right down to the bottom end of it, and then we've been bouncing since then. And if we go back to the daily chart, you can see that we're a touch oversold short term, and that's been the question. Do we get a little bit of a recovery bounce first? We'll have to wait and see how that plays out. So thanks, as Zach said, for taking time out of your trading day to be with us. Hope you found that informative and a good use of your time, and have a great rest of your week, and look forward to talking again soon. Take care, everybody.